On to the next one, guys. We need to talk about the average US FICO score. It dips as consumers struggle to make ends meet. Womp womp. This is from Forbes. This is, I kind of guess, what I was expecting at some point.
Yeah.
You can only have enough warning. I mean, not enough. Yeah, how many warning signs in the economy do you need to see, or from the Fed, or just from prices and all that, before you go, trouble ahead? And here's some evidence of that looking back. You saw that the average FICO score in the United States dipped near the end of last year, into 2023. And it was the first drop in a decade, signaling it may become tougher for some borrowers to finance big-ticket items like cars or houses.
In a decade.
So, again, long time frames again, where, hey, new record. Great. Yeah. What just a fun
breaking
record.
All the worst records, huh?
Yeah.
For me, I mean, it comes to no surprise, like with higher costs of like goods, services, products over the last 2-3 years, well, of course, the credit cards are going to be having to carry the weight if incomes aren't rising, and they haven't really over the last couple of years. So those who haven't had that, income match with the cost of goods and everything has been going up as well, then you're really going to have to turn to an alternative way of being able to keep up with what you need to pay every month, every day, whatever it is that you have to get by, because you still have to pay that same amount, even if it's more than what you budgeted for before last year. I mean, you brought up an example where the guy's shopping at Walmart and he has his cart from 1 year ago compared to this year, and it's just getting smaller and smaller and smaller of what you're able to basically purchase with your dollar.
That was actually Andy. It was like he spent like $400.
It was the same items in the cart were $400 and change. It was like $140 or something a year or two prior. But the issue, it's like the everyday purchases, right? If your income's not keeping up with the accelerated pace of the price of everyday purchases, then you're going to resort to the credit card. Well, now the problem today is that it's not the credit card rate of before; it's today's credit card rate. So you have, FICO not as a result of just credit cards only, but look, that is a huge driver when it comes to how much consumer spending is happening, and we see credit card totals passing 1.1 trillion in the first quarter. So it's like it's all this problem, but like it's scale. Like, I'm having this problem in my monthly budget. Oh, and so are millions of other people.
Yeah, no, exactly. I mean, this comes at no surprise. And again, unemployment has risen. And so that's what the Fed wants. In order for inflation to start going down, we need to see more unemployment. As a matter of fact, last week I had a couple of clients call me, seeing if I can do a home equity line of credit. Of course, we can do those. We could offer that. But one of the caveats was, I have a ton of equity, but I have no job. Well, how do we
prove the difference?
That you can support your house payment and that new equity line of credit? So we're like, do you have a job offer letter from another company? He's working on it. But that was the same, story that I heard from the last two clients, and those are the realities that are going on right now.
Oh man!
These things
you weren't able to. I
can't. You can't.
Well, the reason I'm asking if you weren't, because last week we were talking about a couple scenarios where people were just, their consumer debt was like through the roof, and they're like, was the saving grace was the home equity line of credit, but not in this case.
Yeah, which gets me to the next story here. That I want to share. People don't know this, and this is what's cool with this article. It's actually informing people the importance, right? And this is like whether consumers make on-time payments. Well, making on-time payments, that's around 35% of your credit score, which is awesome. Yes. That's pretty high up there, Then the credit utilization, that means how much credit card you're using on a regular basis. That's 30%.
Yep.
Yep. And so right now, the most important, what's impacting people is that credit utilization. People are using their credit card in order to pay their debt. So they're kind of using like, what do I have? I don't have money in my bank account, because we already know we're one of the nations that save the least amount of money anywhere.
Debt driven.
Yeah.
You know what I mean? So we're going to use our credit cards, and that's why it's at that 1.12 trillion.
And you combine those two things, and you have 2/3 of your FICO score from those two elements.
Absolutely.
So, your payment history and the utilization rate.
Well, the utilization, I want to go to that, back to that on a story. Right now, I'm working with a client that we're doing a VA cash out refinance. I reduced their rate down to 2.25. They were at 740 mid credit scores. When I did that, I ran credit. She was at 608 and he was at a 648.
What?
And so I'm looking, what's late? What did they pay late? There was no late payments. All payments being made on time. 35%.
It was utilization. No way, really?
It's $102,000 worth of credit card debt.
Oh my God. Wait, what?
And then it was another $75,000 in just installment.
Oh my gosh.
But the cool thing here, thing about that is we're moving forward, but we have to do a rapid rescore. Luckily, when we run credit, we're able to know what we have to do in order to get that credit above a 640. That's the goal. so that at least the interest rate makes sense for what they're doing. But even at that 6.25% that we're going to get them, Andy, after paying off all that debt, which is we're taking $170,000, after paying that debt, excuse me, they're going to save like $2,500 and change a month.
Monthly out of pocket.
Out of pocket. They're just going to save. And remember, we only calculate the debt, the minimum payments on the what's shown on the credit,
which is
we
not,
don't know.
Which is dang, that's a lot.
Yeah, so I'm easily thinking that's going to save them around $3,500.
Yeah.
So
that's crazy.
I told them from that 38, you're going to go to $6,500. But now remember, you don't have none of that installment
Put that
loans.
back into your loans.
You do have your car loans because they have car loans.
Oh, okay.
And a student loan, not that high, but at least we're paying a lot off.
Before we continue though, can you please explain a rapid rescore to anybody who doesn't know what that is?
Yeah,
can
so
you tell everyone what that is?
When we run credit, when we do a rapid rescore, what we actually do is we want to pay down some of those credit cards to a certain percentage, and normally it's around 30% or lower
of the balance
of the current high credit limit. High credit limit, actually. So some of them, like we just had to do 3 cards in this case, and it was like a total of $1,400 and change. And then so when they give us letters providing that, okay, they paid it down, we'll go to Equifax, Experian, whatever credit bureau in there, we'll submit that, and it takes about 5 to 7 business days for them to reflect that. And then the company that we run the credit through, they'll verify that information, and the credit increases to where we need it to be within that 5-7 business days.
So this is a method for those of you who are interested in this, you're trying to refinance out, or you're trying to figure out what to do regarding your credit, and then maybe it's plummeted from a 740 to 608 or 648 or whatever, and it's because of utilization. The rapid rescore is a way to do this quicker than the normal cycle. So if you had paid it off today and you had to wait 30 days for it to report, you can do it through rapid rescore through the system that we have, and everyone else has too, in order to get your score re-rated between your last payment period and the next one.
Yeah, and the reason why we want to do that is because there's tiers, right? So it's going to be, we can do the cash out at 608, but the interest rate's just going to be terrible.
Yeah.
So if we pay $1,400 for this, and we share that burden, we cover the cost of doing the rapid rescore. This is not something that gets passed on to the client. That this is a service that we provide, right? So if we get them to that 640 tier, the rate's a lot more favorable. It'll go from that 6.875 down to a 6.25.
Yeah, absolutely.
That's a lot. $300-$400 difference a month.
One of the conversations I had last week with the client was between a HELOC and a cash out refinance, and we ran the numbers. If they would have done $100,000 on a HELOC, their rate would have been 11.5%, and the payment would have been like $990 additionally a month.
Yes.
So sometimes, and I always say, just compare both. Even if you don't have the want to do a cash out refinance because you don't want to touch it first, run the numbers. That's gonna give you an honest opinion. But we ran the numbers at a cash out refinance, and same thing, consolidating the exact same amount of money, getting them the exact same cash out. Their rate was going to go a 0.375 from a 5.875 to a 6.25, and their payment only goes up $773.
Okay.
But it's not going up. Their out of pocket is going down, right?
Yeah.
And then there's a difference. I asked them, how much are you paying a month in monthly debt? She's like, $2,400.
Oh.
So I'm like, okay, so now you take off that $2,400 plus the $773, and that's the difference of what they're taking home. And they're like, hey, well, we were already used to paying $49, $60, whatever. So we're gonna throw the difference of the money and just put it right back into our mortgage and be debt free, but be able to pay our house a lot faster and just be able to call it a day.
That's the way.
Yeah. And what I want to drive home is that everybody's infatuated about getting a HELOC because they don't want to touch their first loan. But honestly, once you run the numbers, you're going to clearly see that even if you get the HELOC, don't touch your first, you're going to be paying more regardless. And the advantage with the cash out refinance is that you don't have to later down the line refinance that HELOC out or have to pay it all off. You continue to make your one payment at a low rate, consolidated 30-year fix, and then you just pay off all your debt freely and clear.
Yeah, and here's the other thing with the HELOC. The interest when you're using it to pay off debt is not tax write-off.
It's not worth it. Yeah.
It's not a tax write-off. So that's another good point that you got to actually see, right?
It's not mortgage interest.
It's not mortgage interest unless you do home repairs and you're doing something there. Correct, and you're going to have to prove that, right? But
that's not what we're talking about.
No. So these people are going from a 6.25 up 4%.
Yeah.
You know what I mean?
Yeah.
But the whole goal is like, hey, stop making those payments there. And I share the same thing with them. I'm going to share the mortgage accelerator calculator with they pay $500, $1,000 back to their mortgage because they're already used to doing that. Now they're reinvesting into themselves. and it's going to take them. It was going to take them 7 years to replenish everything that they used by taking this route. And now the mortgage interest is a tax write-off, and therefore they'll get more money at the end of the year because of it. So there's a lot of good, a lot of pros for this.
You have to be tactical about this.
Very tactical.
We talked about this last show, and I was kind of saying to people like, hey, listen, like we're not saying that, hey, you made a lot of bad behaviors financially. Let the house be your rescue. I mean, we are saying that in some cases, but tactfully. Don't just go into it like without a plan, but coming into a plan puts you in a much better situation long term.
No, absolutely. But you know what, Andy? In some states where you go, luckily we have that.
Yeah. Right.
Luckily we have that.
Well, yeah. What would be the alternative?
These people is a sinking battleship for them, right? They bought a nice investment for their family, but they're getting over their heads where now it's going to become difficult to start making their credit card payments.
Because for some people, the solution is selling the house, which then now you don't have the house.
So luckily, we saw this appreciation. Now it's time to leverage. Now it's time to utilize that equity, and luckily we had it. 2008, 9, 10, that wasn't the case.
So one of the things I just want to I wanted to make sure I made a point of, because I'm a little bit more on the bitter end of what the Fed does, is they're talking here about how first of all, I think there's a warning sign with our total balance of consumer debt being over $1 trillion, number one, and growing. I don't like that, and that the 8.9% of credit card balances became newly delinquent for the first 3 months of the year, the highest in 13 years. That's a warning sign. Warning sign to creditors. You better watch out. The Fed is not going to come save you, people. The Fed is not going to come save you, creditors. And here's why. Even though they want to have a 2% inflation, they're not going to be able to walk back the year that it was 9, the year that it was 8, the year that it was 6. It's already up there. It's elevated. It's staying, and it's just slowing down at 2. So unless you get your arms wrapped around your debt right now, you're going to be facing an uphill climb and an uphill battle. They are not coming to save you. Work with your home equity to figure out a solution. Do it tactfully. Do it smart. Change your behaviors. If they're bad behaviors that got you into it, let's work on some new behaviors that can help you get out of it.
And I'm going to piggyback off that. When you're looking to do a HELOC and a cash out refinance, a HELOC is going to be heavily dependent on your debt to income ratio and your credit. So that means that if you have high balances, all your credit cards are maxed out, you have a very, very minimal chance of getting approved because they know exactly what you're doing. Yeah. And they know exactly what you're going to use that HELOC for, right?
They're seeing it.
The story is there.
Yeah, but on the flip side, with the cash out refinance, they allow a lower credit tier. You're able to have a little bit more leeway of what you're going to use those funds for, and you might have a better chance of getting your loan approved. Yeah. So if you're looking to get a HELOC, make sure you do it before you start running up all your credit cards and it's like, hey, I really need it. I'm drowning. No. Take your time and do it beforehand, because you could also be hurting yourself if you do it at the last minute.
That's right. And there you go.